Hello, everybody, and welcome to today's training. I'm Rachel Neighbors. You're here with Neighbors Group and Solo401k.com and the one, the only, the man, the myth, the legend, John Hyre. Hey, John, how are you?
Good, thanks. I'll take that. The ego, the head. I mean, it'll outgrow the screen and we'll need to fix it.
Yeah, that's okay. We'll adjust the proportions later. It's cool.
So my wife will be in touch.
Yeah. So welcome everyone. Today is a really awesome training. If you were with us a couple of weeks ago, we touched on the Secure Act with CPA Nate Bush. Nate is awesome. And you guys had a lot of questions still left over. And the Secure Act, it is a meaty piece of legislation. It's a big overhaul to a lot of different areas of how we get our money in retirement accounts. So we wanted to bring John on. He is incredible. He's a superstar in this space. I know that many of you already know him. That's why hundreds of you are here. And so what we want to do is we're going to dig into the Secure Act even more. But before we get started, you know, we like to do our little tech check. Let us know, can you see us? Can you hear us? You should see a chat bar on this side of the page. Just let us know, yes, I can see you. Yes, I can hear you. And maybe tell us your name and where you are joining us from. I know we've got clients that are here from around the country, some of you around the world. Hello. Okay, it's all starting to flood in now. This is great.
Oh, yes, Maureen.
Hi, everybody. And John, I know that you are going to know some of the names that are on here in our network at solo401k.net, which is free. It's open to everyone. We call it like Facebook, but it doesn't suck. It's an opportunity for you to get to schmooze and network with other Solo 401k IRA investors. As soon as I posted that you were coming to do a training with us, John, it was like the comments were filled like, oh my God, I pay thousands of dollars for John to, tell me stuff that's going on. You guys have to join this training. So, all right. Yes, great, fabulous. There's a lot of people flooding in. This is awesome. Let's get right down to it. So first, John, the Solo 401k and the IRA is a specialty niche, okay? Just doing retirement accounts in general is a bit specialty. Really focusing on self-directed retirement plans is even more niche. And you're an attorney and an accountant. So what caused you to go into that field? What sparked your interest in that?
So the generic field, I believe in liberty. So I want to help you keep your money. I don't like government. I don't like them having your money. And at least for now, we're going to follow their rules and keep your money with you following their rules. Second, I like the chess game. I like the strategy, the playing. It's just fun. And finally, it does pay in a non-trivial manner, which I like. So that's what got me into it. Now, how did I get into the self-directed space before the solo self-directed space? I actually had a client, it was like 2010, asked me to do an IRA audit. So I'm one of the few lawyers who's actually done self-directed account audits. And we took these two of them all the way to tax court. We won both. And I told the client, I'm very honest to the point of bluntness. And that's one of our caveats you'll see on the PowerPoint slides, that I'm super honest and offensive and not for the delicate. So if you're delicate, if you've ever used the words, I'm offended, and expected an adult to take you seriously, this would be a great time to sign off, because I'm that guy. But what happened was I told bluntly the client, I've never taken a self-directed IRA to audit. You need to hire someone who has done this. I don't want to screw this up. This is important. And he said, well, I admire the honesty, but we can't find anyone who's ever done it. So you're it. And I'd done self-directed IRA work before that, and solo work and 401k work. But that was the first audit. And it led to a lot of wonderful things. We won the audit, and this is embarrassing. So I represented him in the audit and in tax court, got the IRA to drop his $150,000 bill to zero and charged him less than $5,000. That's embarrassing.
Never make that mistake again.
No, and I won't. So don't any of you get your hopes up. It does not work that way anymore. So that's what got me into the space, and then into the solo case. Look, in 99% of the cases, and we're going to talk about one exception to the rule, but in 99% of cases, the 401k is superior to IRAs, to SEPs, to any of those other accounts. And I'm sure you've talked on your education about how and why that is. But the two things I really, really, really love: prohibited transactions don't kill the account. So we don't want to do prohibited transactions, but I like the idea that it's not fatal here. And second, the fact that UBIT does not apply when you're borrowing to acquire or improve real estate, which since so many people do real estate in these accounts, it's a narrow but massive exception. And there's more that I'm sure you've discussed, but that attracted me to the 401ks. And then, of course, the solo Ks, what's better about them? Cheaper, simpler than a normal 401k. So it's the pinnacle, sort of like the apex predator of the retirement account world.
Yeah, that's a really good way to put it. I like that apex predator of the retirement account world. And I like what you said earlier about the puzzle. So one of my mentors told me you can hate taxes and love the tax code. And yeah. I do. I love the tax code because there's so much that's in there that can work to your advantage if you know to look for. And if you know how to play in the rules the IRS has already created. So they've created those rules, but most people don't know how to take advantage of them legally. So it's like finding, El Dorado or the pirate's treasure when you can really dig into that. So right on, cool. Well, I know that there's a bunch of people that are like, yes, we love John. We hate Rock. You're great. Rock says, I hate the F word, feelings. Yeah. So you're definitely among friends here, John. And for those of you that are
my people.
Exactly. And for those of you that are asking, yes, this will be recorded. Yes, we will send it out in the newsletter this Thursday. Yes, it will be on the 401k network at solo401k.net. And yes, it will be on the blog at solo401k.com. So if for some reason you have to jet out early, or if you can't write all of these nuggets of wisdom down as quickly as John can spit them out, then that's okay. You can go back and listen to this webinar recording at any time. So, and just as a little test, for some reason, our video or audio gets a little weird, you can always refresh your screen. So Courtney and Richard said they lost my video. John, can you still see me?
Yeah, it is breaking up a little bit, but it comes back and I can hear you the whole time.
Okay, cool. So I'm not the star of today's show, so don't worry too much about me, guys. If for some reason the video or audio gets funky, you can always refresh your screen and reload the webinar feed. It's not going to kick you out. It'll just reload it for you. So John, I know that you have a presentation prepared for us. Whenever you're ready, please feel free to share your screen and take us on in.
All right. Let's see if I do this right.
Okay.
All right, so I can see my PowerPoint, but not the screen. So I can't see the horrified expression on your face when I do horrid things.
Just imagine us staring lovingly at you and you'll be fine.
Cool. So Secure Act is going to be the focus. I did slip in a few slides at the end that were non-Secure Act because, well, the neighbors are very extant in terms of the education they provide you. So quality and quantity. I have some idea of what you've already seen. This will be some repetition of necessity, but I wanted to put my own little spin on it and try and make it unique for you as much as I possibly could. Our contact information is there. We take clients all over the country. It's all virtual. We've been that way for about 20 years. Yes, I'm in Puerto Rico, and yes, there's a massive tax break for being here, among other things. So we really enjoy it here. The caveats. Legal advice is not what you're getting today. It's education. Legal advice is specific. And that's when I'm talking to you, getting your personal facts. You're paying me $500 an hour. None of that's happening right now. This is generic in general, which means it's education. If you apply the education as if it were legal advice, not only is no one liable, but we will laugh at you as a Darwinian experiment gone horribly right. So I would recommend refining what you learned today, which shall be very useful, with actual legal advice. And remember, and I'm not kidding, I am not politically correct. I am not sensitive. I will not change my vocabulary to please sensitive people who need brownies and petting goats when elections go in a way that they don't like. If that's you, really time to tune out, because not only do I not care about your feelings, but I take a certain joy in trampling upon them. You have been warned. Qualifications. I've been at this for 25 years. I'm an attorney and an accountant, and you'll hear me talking to myself sometimes. The attorney argues with the accountant. It gets really interesting when we throw in the Transcarpathian village idiot and some of the other voices. We're going to try and keep it to just the two personalities, but they are there, and they each bring something different to the table. I have represented self-directed IRAs, as I mentioned, in audits and in tax courts. I've got some pretty hands-on experience. I also go to DC. The tax court is antiquated. There's a lot of information that they only share at the tax court in a little room in the building on dead tree, and you pre-order it. So for example, when I see a case come out, I don't just want to see the decision. I want to see the shopping cart full of lawyers' briefs, the client's tax returns, the depositions, the cross-examinations. I learn a lot from reading all those materials. And yes, I actually fly to DC, go into the little room and spend a few days with the shopping cart, and the people cart all this stuff out, and then I copy the good parts and so forth and so on. So bottom line, yeah, I probably need to get a life, but I do so enjoy this. All right, so you probably know about this, but let's go over it again just to be sure. One of the major changes with the Secure Act is the deadline to set up and contribute. Now, there are some problems with it. This is very typical when things are written in haste, or even when they're written well, but the law is so complex, even the IRS and Congress aren't aware of all the law that's out there. Now, in a normal world, that would mean simplify the law. In the world we live in, now let's keep piling on. So let's walk through it. Self-employed persons, which would be most of you, or if you have a solo K, you're presumably self-employed, can establish and fund the plan as late as the extended tax deadline. I'm just going to assume you all extend, and there are good reasons to do that, by the way. September 15th is the date for S corporations and partnerships. October 15th is the date for C corps and sole proprietorships. So you have until the extended deadline to do all this. Now, a word of caution, I probably would not file before the extended deadline and then establish the plan and make the contributions. You may have to amend the filing, and even if not, there's a little bit of ambiguity for me reading the statute. Do they really mean September and October 15th? Or do they mean the extended deadline or when you file the return, whichever sooner? Let's not find out. Make sure that if you're going to set up the plan and contribute to the plan, it's before both the extended due date and before the actual date that you file. You can prepare the return ahead of time. That's actually a really good idea, so you know what's happening, but don't file it. Don't actually submit it until you've gotten these various things done. Now, Otto von Bismarck had a great quote. Those with weak stomachs should not watch sausage or law being made. Both are messy. And so what happened? You have to designate contributions technically by December 31st, which if you think about this, wait a minute, I have until possibly October 15th to set up the account and fund it, but I have to designate what the contributions are going to be still by that unfortunate 12/31 of the same year deadline. That's presently the law. It may be an oversight. What's been really common for the last 3 or 4 years is that the statutes are kind of sloppy and the technical corrections catch up with the statutes later.
It's like a ready, fire, aim, right, John?
Oh, yeah. Oh, my God. Yeah. So this 12/31 designation issue will hopefully find its way to a technical correction. And I think it will. I would bet on it. Why? Because the intent was to give you time. And I think they just forgot about this technicality. What does that mean? For 2021, look, designate, and I have a slide on how to designate. Designate before the end of the year in 2021. That way you just don't have the issue of, gee, do I have until sometime in 2022 to designate? And it's a pretty simple thing to do as long as you don't what? Procrastinate, which is, entrepreneur 101. It's what you guys do. I understand. The same thing that makes you really good at finding deals also makes you procrastinate on paperwork. I get that. Try not to do it on this. What do you do for 2020? Well, there's some risk. I would be comfortable with the risk personally, but I'm pretty aggressive. But there is some risk. In other words, if you have not yet designated, let's say you're thinking, great, I can set up a 2020 401k, I can contribute to it, yeehaw, but wait, I did not designate in 2020. There's some risk. We're going to talk to you about how to minimize it, but there is some risk. Maybe the IRS goes the other way and says, no, we don't care what Congress said about funding and about setting it up later. We got you with this designation thing that we forgot to put in the statute. I don't think that's what will happen, but there's a greater than zero chance that is what could happen. We'll talk about that more in a minute. So remember, for 2020, if you haven't designated by the end of 2020, there's some risk, and we're going to talk about what to do to ameliorate that.
And this is even kind of the weirder or the weirdest of all of the years because we're in that in-between phase, right? Secure Act was passed in December of 2019, which meant that 2020 and into 2021 is the first year that this is all happening in reality. So this is when the IRS and everybody else is kind of figuring things out and stumbling along as they go. Oh, and by the way, it happens on the heels of the pandemic. Oh, and by the way, it also happens on the heels of the CARES Act, which lets you take money out of the retirement plan, which the government has never let you done before. So like you said, there's this sort of mishmash of all this stuff going on.
Oh, and by the way, it happens on the heels of, unlike the rest of us, the IRS has the COVID excuse that their employees can keep getting paid and not show up to work. That must be nice. And so a lot of things that would normally get done have not gotten done, and that's created vast, massive chaos. All right. Remember, there are two fundamental ways to contribute to your 401k accounts. If you have a corporation, whether it's an S or a C corporation, your contributions are driven by your W-2s. And by the way, normally I prefer that. I prefer W-2 based contributions because I can manipulate the W-2 and I can know what the W-2 is going to be. If you have a pass-through, a partnership, an LLC taxed as a partnership, sole proprietorship, most single member LLCs, in other words, you're not issuing a W-2, your contributions are based on the net profit of the business. What do I not like about that normally? A lot of you don't know if you had a net profit or how much it's going to be until way later, way later. So it's unpredictable, not as easy to control. However, in this case, contributing with a W-2 creates issues of, well, how do we fix our 2020 W-2? It's doable. You got to talk to your payroll provider. Some of your payroll providers are going to say, this is wrong, you can't do it. And that's where you either have to persuade them. I've already been on the phone with several and persuaded them that, no, this is legit. It's harder to do with the big ones. What's the nice thing about dealing with, say, ADP? They're cheap. What's the bad thing? If you don't fall within their box, they're hard to deal with. They don't do well outside their box, and their box is rather small, but they are cheap. Where when you're dealing with, let's say your CPA is doing your payroll or someone like that, they're usually more flexible. Bottom line, the W-2 rules are also not yet in conformity with the Secure Act. The IRS will probably do a fix, but a lot of these payroll providers don't understand that salary deferrals do not need to be done by year end. So you're going to have to talk to them some. And they're probably going to have to amend W-2s and the returns, the 941s, if they've already been done. That's annoying. You have to do a cost-benefit analysis. What does it cost me to amend? But what's my benefit for having this massive, preferably somewhere between $58,000 or $57,000, depending on which year we're looking at, to $63,000, $64,000 contribution to our 401k. So you have a cost-benefit decision. We mentioned formal documentation. What does that mean? What does that mean to document that you were going to contribute by December 31st? You do this documentation if we want to be safe, that you were going to contribute, and then it allows you to take advantage of the rule that says you can set up the plan and contribute to the plan by the extended tax deadline. Formal documentation is putting it on your corporate books. Now, I do a lot of entity work, and I'm more stringent than most lawyers on what you need to do to properly maintain your entities. And that's a discussion for another day on what are those requirements and why am I more stringent? Why do I ask more of you? There are good reasons for it. But what you should have is a set of corporate books. I like a nice 3-ring fake leather binder with brass-coated rings. I mean, I wouldn't do real leather or real brass because it's real estate investors mostly on the call, and they're much too cheap to do that. So we got to go with fake. And the binder is going to have tax returns and quarterly profit and loss statements and quarterly balance sheets from your QuickBooks, your formation doc, your EIN letter, resolutions, which are pretty important, annual meeting notes, which are pretty important, and a spray that gives the new car smell. And that's sort of a joke and it's sort of not. Why should you have all those things in your corporate binder? The ultimate purpose is to persuade a judge you've never met until when you finally meet him or her, that you are a serious business person, that your entity should be respected, that you should not be personally liable for something. And so the short list that most lawyers give you that the statute requires you to do to maintain your LLC or your corporation is usually too short because we're trying to persuade someone. All of these things I've laid out down here, right down to a sense of gravitas, a look of formality and a sense of seriousness, and hence that new car smell that makes it seem like, you know, this is a business and it's serious. That's our corporate books. Where would I put this formal documentation in the corporate books? I would timestamp it. You could take a picture. If the picture can be dated, you can send it as an email. If you want to get crazy, you can go get it notarized, but get it dated. Now, what would I do if you haven't done it yet? I would not lie, right? Once you start doing things like backdating and making false statements for federal purposes or on federal documents, that's bad. Now things go from being a money issue to potentially being you get nocturnal visits while undressed in orange at 2 a.m. from large people who do things involuntarily. We don't want this. None of us do. So don't lie. Don't backdate. In other words, if you haven't done the formal documentation, make a document that says, we're going to contribute this much as of 12/31/20, but when it comes time to sign the document, put the actual date on it. Don't be deceptive. There's some risk to that. Maybe that's acceptable, maybe it's not. Am I comfortable with that risk? In other words, if I were in the position of not having done my formal documentation by the end of December, would I do what I just described? Absolutely. As long as I put the proper signature date, so I'm not misrepresenting to anyone, I'm not lying to anyone, would I do it? Oh yeah. Could I be wrong? Happens all the time. I'm married, right? So anytime I open my mouth at home, I'm wrong. I'm used to it. I deal with it. RMDs, required minimum distributions. So all accounts except Roth IRAs are required to start distributing. I'm not going to go into detail. I think most of you are familiar with the concept. The point is to point out that the new starting date from 2020 onward, and actually in 2020, they weren't required because of COVID. So really in 2021, the starting age is 72 instead of 70 and a half. And right now there's a Secure Act 2.0 in the works, and they're looking to change that age to 75. We'll see how that goes.
Because people are living longer? You think that's why, John?
Yeah, exactly that. They're living longer, and so it makes some sense. Of course, now the IRS needs a revenue offset when they do that, because allowing people to wait to distribute reduces their revenue. So they have to find other offsets, and that's where things get unfriendly. You don't want to screw up RMDs. The penalties for messing it up are massive. It's 50% of the difference. And for example, you were supposed to do an RMD of $1,000. You do one for $900. The penalty is $100 times 50%. It's 50% of the difference. So it's a huge penalty. The only way to really avoid it is roll to a Roth IRA. And I want to make clear, it's a common strategy. It's been discussed elsewhere here, where you roll from the 401k, preferably the Roth 401k, so you're not paying the conversion, to a Roth IRA, and that way you avoid the RMDs. But a couple things come to mind. A, the Roth IRA is not a robust account. You have to be much more conservative about prohibited transactions, because a prohibited transaction will destroy a Roth IRA, where it merely results in penalizing a Roth 401k. So you want to make sure that you're more careful. Bear in mind, you can continue to feed the 401k at the full rate. The fact that you rolled most of the money, let's say your 401k is all Roth, you hit the age of RMD-ness, you roll almost all of the 401k Roth into the Roth IRA, you leave, I don't know, let's say $1,000 in the 401k. Can you keep contributing the 60, 70, whatever grand you contribute to it every year, as long as you otherwise meet the requirements? Yeah, the fact that you rolled most of the account to a Roth IRA does not mean you cannot keep contributing to it. If you have traditional accounts that are not 401k, I would roll them to the 401k for reasons I mentioned briefly and deeper reasons we haven't discussed because we only have an hour. The 401k is overall superior to your SEPs, IRAs, simples, etc. So I would do the rolling. A note for those of you who are Roth maximalists, for those of you who want everything to be Roth, there's an exception to the rule. If you give a lot of money to charity, this is usually my tithers, but those of you who give a lot of charity, who believe in giving, not giving back. Giving back's a BS socialist term designed to make you feel guilty like you owe people something. I'm not giving anything back. You didn't give me anything. Therefore, I can't give anything back. I'm just giving. Why am I giving? Because I have gratitude for the wonderful life I live. I won the temporal lottery. I was not born in 1600. And I won the geographical lottery. I was born in the US. I'm grateful. I want to give. So if you're going to give large amounts, here's the way to do it. Traditional IRAs can give up to $100,000 straight to a charity. It meets your RMD requirement, or I should say it counts towards the RMD requirement, whatever it is, and it's a tax-free distribution. If you plan on doing that, don't convert everything to Roth. It would be inefficient. In other words, if the charitable contribution is going to come out of the traditional IRA tax-free anyway, because it's a charitable contribution, why pay the tax to convert the traditional to the Roth? So you have to plan ahead. What are my charitable giving plans? Let's plan on doing that out of a traditional IRA. And it doesn't have to be a traditional IRA till the last minute. In other words, can I keep the money in the traditional 401k, roll 100 to the traditional IRA, then give to charity from it? The money comes out of the traditional, it comes out tax-free, but because it's a traditional, I still got my tax deduction whenever it was that I funded it. So for the people who are going to max and go all the way with Roth, which for some of you that makes sense, I would think twice if you do a lot in terms of charitable giving. So watch that last bullet point at the bottom. Part-time employees. All right, so the law changed it, right? A common strategy was to exclude part-timers, which was defined as people who had 1,000 hours or less per year. The rule has changed that if it's less than 1,000 per year, they're part-time, so you can exclude them unless what? They worked 500 hours per year or more for 3 years in a row. 500 hours per year or more for 3 years in a row. They're not part-time. You can't exclude them. So if you've got one of those, you no longer qualify for a solo. Now you can still do a self-directed account, right? You can set up, for example, a self-directed safe harbor 401k. What's the downside? It's a bit more complicated and a bit more costly than a solo. So it's not as optimal in terms of cost and efficiency, but there's still the ability to self-direct even when you have employees. Now, your 401ks, your solos, do not have this in there, and here's the reason. In other words, you don't have the ability in the plan you have with the neighbors group, as I've understood it, to discriminate against part-time employees for two reasons. The first one is a lot of you shoot yourselves in the foot. Well, we're going to exclude anyone with 1,000 hours or less from the plan, and then you take a look at your own hours after you put that in the plan doc and go, oh, damn, I just excluded me. That wasn't part of the plan. And the other one is that the IRS, even though it's the law, is not super fond of this approach. So you can do it, but sometimes you decide there are things I can do that I might avoid because there's indirect collateral consequences. So if you have the issue of 500-hour employees per year, 3 or more years, you want to do one of two things. You either want to start thinking about a self-directed safe harbor plan, or you start talking to your friendly neighborhood plan provider, and we know who they are, about will there be possibly maybe down the road at some point in time, perhaps changes to the plan. I will punt on that question.
Open to it, John. Thank you.
5,500 EZ. All right, let's talk about that. Here's the usual advice. Don't file a 5,500 unless it's required. I think that's mistaken. So this is where the lawyer fights with the accountant. The accountant says, don't have to file, don't file. But the lawyer says, well, first of all, when do you have to file? If your plan assets are 250 grand or more, you have to file the 5,500 EZ, which is the form that single member 401ks file. And even if your spouse, for example, is included, it's still considered a single member plan. A lot of people say, let's avoid the form, let's avoid the hassle. Well, first of all, it's a really cheap and easy form to file. It's not that hard. Why do I, the lawyer, want you to file it? Statute of limitations, right? If you don't file a 5,500 or a 5,500 EZ, you're open to audit forever. That makes me sad, so very sad. If you file it, the statute of limitations starts. And the statute of limitations, depending on some factors, is anywhere from 3 to 6 years. I like a statute of limitations. I recommend filing a 5,500 EZ each year. You're going to find it's cheap and you get peace of mind knowing. You can even have a bottle of champagne ready for when the statute of limitation passes. That's a cork-popping day. Let's all be happy.
Can I ask a quick question? And I know we're not to questions yet, but this is just a quick one. Could a yeah, I know, sorry. Tisk tisk on me, guys, not sorry. So could a potential PT, okay, if the IRS suspects, maybe let's say with good reason, that you've committed a prohibited transaction, can that bust the statute of limitations?
I don't think so.
Okay.
Let's make an analogy to IRAs, because there's no clear law on 401ks, but the court often borrows from other law. For an IRA, when you file your 1040, that's the relevant return that starts the statute of limitations clock ticking. And for an individual, it's usually 6 years, in some rare cases, 3 years when it comes to IRA PTs. So if you file a 1040, the IRS has 6 years from the filing to uncover the PT, or they don't get to audit anymore. There's no law, but given the logic and that IRA case, I think the 5,500 would have the same effect. So you file the 5,500, you count for 6 years. Once that time passes, I think they can't look at PTs during that period anymore. And we saw an IRA case, a very sad one, where someone did not file 1040s because they were not required to. The amount of income showing was low enough, they were not required to. The IRS went back 10 years, found a PT, and the statute of limitations was open, and so bad things happened. It was most sad.
Good example, thanks.
Okay, the stretch. So the stretch IRA, also known as the inherited Roths. Unfortunately, it's down to 10 years. So they didn't kill it, but they sure as heck chopped the legs out from under it. It used to be the life expectancy of the person who inherited, and we would have really young people like grandkids inherit, and it was wonderful. That is now gone, right? So if you had before 2020 an inherited account, you get the old rules, yay. 2020 and after, it's the new rules. But let's look at them. There's still some advantage. It's just not what it used to be. Basically, anyone who inherits the 401k will almost always convert it to an IRA. It'll be an inherited IRA. It's a conversion. And this is really important. We're going to talk about that in a minute. So they have 10 years, and you don't have to do anything during the 10 years. You can do the tax planning of, we'll distribute a little bit every year over the 10 years, or we'll just distribute everything in year 10 and take it all at once. Depending on whether it's traditional or Roth, you want to think about how you approach that. There are exceptions to the rule. Spouses can inherit, and they get the full stretch. So it's not just 10 years. Kids can inherit. They get the stretch until they hit the age of majority, which is 18 in most places, 21 in some, plus 10 years. Now, here are some fun ones. If you're disabled, if the person who's inheriting is disabled, well, I'll be curious to see what the definition of that is. I've met a lot of people that, in my opinion, are highly disabled. They don't seem to think so and get offended when I tell them so. But, go to Facebook. You'll find a lot of these people. Chronically ill individuals. Now, that's interesting because it doesn't say a really nasty chronic illness. It just says chronically ill. And so I'll be curious to see how that definition plays out. I've had sinus issues as long as I can remember. Am I chronically ill? That's a great question. I fully intend to play with that. If the beneficiary is no more than 10 years older or younger than the decedent, the person who passed away, then the rules don't apply. And I guess the theory is there's not much of a stretch, assuming that the person who died was elderly, which is usually but not always the case. And an important note, something I've seen people miss, and it makes me sad. So it's sort of related, and I thought I'd throw it in. 401ks, let's say you inherit a traditional IRA. You cannot convert it to an inherited Roth. It becomes an inherited traditional IRA. It does not get to become an inherited Roth IRA. So if you inherit a traditional, it's like Vegas, it stays traditional. 401ks are different. If you inherit a traditional 401k, you can convert that to Roth before it becomes an IRA. Let me repeat that. If you inherit a 401k, unlike an IRA, if it's traditional, after the person you inherit it from has died, you can convert to Roth if you're willing to pay the price and enjoy the stretch as a Roth instead of traditional. Now, there's a bunch of math involved as to whether or not that's a good idea, but the point is you can do it. You have this flexibility. So inheriting a 401k in this regard is better than inheriting an IRA because you have some optionality when it comes to converting. And that's an important little bit of flexibility. There are things you have to do. There are details involved. So if you inherit a 401k, don't just sit about. You have to talk to someone who knows what they're doing. There is, of course, a procedure. In fact, preferably, the 401k itself had designated beneficiaries before this all happens. We need that to happen. There need to be beneficiaries designated. If it transfers as a matter of law, the consequences are less happy. So for IRAs and 401ks, we want beneficiaries, and we want beneficiaries in case the initial beneficiaries die. In other words, the contingent beneficiaries. The act changed one thing, but let's be clear what it is. It said $5,000 distributions for births and adoptions. So you can make a $5,000 distribution for a birth or an adoption, but understand something. Just like the other exceptions for the various hardships and emergencies, it only gets you around the 10% early withdrawal penalty. It does not get you around the tax. So unless you're making this distribution from a seasoned Roth, or in the case of a Roth IRA from contributions to the Roth IRA, you're paying income tax. You're just getting around the 10% early withdrawal penalty. Every year, I see at least 2 or 3 tax court cases that rule on this issue because people constantly forget it. So I just thought I would point that one out to you. Now I'm going to diverge a little. This is no longer dealing with this act. This is dealing with just general IRA 401k planning. And there's a reason, as I'm going to describe shortly. I'm showing you some leg. I'm going to show you some leg, and I'm going to give you a hint. Leg we show for free, but boobies cost. Bring dollar bills. My favorite Roth conversion strategy. This is super important. You really need to think about this, especially given that tax rates are about to go up for everybody. When converting a traditional to a Roth, there's a way to get a discount. Specifically, the estate planning rules say that when you own something in an LLC, owning a portion of the LLC is discounted to the fair market value of the underlying assets. I'm going to repeat that and give an example. Owning a portion of the LLC is at a discount to the proportion of assets. So here's an example. We decide, let's say Rachel and I decide, we each have a $100,000 house. We each put it in an LLC. The LLC has 2 $100,000 houses. Intuitively, you would say $200,000 LLC, we each own half. My half is worth 100, her half is worth 100. That's incorrect, and we're glad that that's incorrect. My half and her half, depending on how we structure the LLC, are probably worth more like 60, 65, 70,000, not 100,000. Why? Because you have a lack of control. Let's say we put a third party in as the manager, then we both lack control. And we have a lack of liquidity. Let's say the operating agreement says, look, the house stays till it sells, or the house stays for 3 years, or whatever. We have a lack of liquidity. Well, under tax law, both for estate planning and income tax purposes, that arrangement means that our shares are worth less than the asset, the underlying asset's worth. So the underlying asset, 50% of 200 grand is 100 grand. But the shares, because of the discount for lack of control and lack of marketability, are only worth 60, 65, 70 grand. So here's a strategy. We just did this. I just invested in medical receivables. Without going into hyper details, one of the things I bought into, I meet interesting people here in Puerto Rico. We met a venture capital guy. They buy debt. They buy they factor. They buy medical receivables at a great big discount. We're making like 18 to 22% annualized, completely passive. The way we structured it was, there were 20 investors with 25 grand each. They all put 25 grand into an LLC for a total of 500,000. We then used a shared appreciation mortgage to lend to the sweat equity guy. We made a loan of $500,000 to the sweat equity guy. He has an LLC that the loan went into. He goes and buys the receivables and makes all the money. What does our loan say? It's a very carefully drafted special loan, a shared appreciation mortgage. I was worried about there being UBIT if we've joint ventured with him. For reasons I won't go into because it's a short webinar, I was worried that UBIT could arise, that we would be viewed as a collection business and UBIT would arise. To get around that, we made a loan. What was the interest rate on the loan? 50% of his profits. A shared appreciation mortgage, also known as a participating loan, we are participating in the profits. Now that has to be very carefully drafted so that it not be viewed as a partnership by the IRS, because if they look at it as a partnership, you're back to having UBIT. That's no fun. What's my point? When people invested 25 grand in this LLC, where I'm the manager, so they didn't have management power, and this money is going to be tied up for 18 to 24 months as the usual time to return on these receivables. So there's a liquidity discount, there's a management discount. What did the people who invested with traditional accounts do? They converted to Roth the next day. We got, it wasn't an appraisal in this case. The numbers were too small to justify an appraisal. We found a CPA who would do in essence, a BPO, so sort of a light appraisal. He did it pretty cheaply, and especially because there was a discount since multiple people were doing it. And in his opinion, the discount was 45% discount. So someone who invested 25 grand, whatever 65% of that is, that's the number they converted at. And they did it the day after. Why? Because the closer we get to there being a cash payout, the closer we get to people getting all their money back and now having control and now having liquidity, the less the discount. So in order to have the maximum discount, you convert the next day. Why am I throwing this out there? This is an example of the type of planning we do. And this is a wonderful thing. This is a wonderful thing. Now you need to talk to someone who knows the case law. Some LLCs get bigger discounts than other LLCs. How you structure this matters. Another UBIT reduction technique. So I often hear that 401ks are immune from UBIT. We don't have to worry about UBIT. I have a 401k. That's not right. That's too broad a statement. 401ks are exempt. Three things cause UBIT. Renting out personal property. Sofas, automobiles, meth labs, all personal property. Rent it out, you pay UBIT, whether you're a 401k or an IRA or an HSA or whatever. Second, you run an ongoing or continuous trade or business. In other words, you buy a Dairy Queen. And by the way, it's direct or indirect. So for example, if you invest in a PPM or a fund or an LLC or an LP that has a trade or business that's continuous, your IRA is treated as having directly invested in that. So for example, if you invest in a PPM that flips houses or buys discounted notes, fixes them and immediately sells them, guys, that's a continuous trade or business. You're subject to UBIT, whether or not you know it. The fact that your 401k did not directly do the business doesn't matter. It's attributed to you from a pass-through entity. What's the third way of UBIT being caused? Borrowing. Whenever you borrow, your IRA, your 401k borrows, it's subject to UBIT proportional to the debt. But there's this glorious, wonderful exception for 401ks, but you got to listen to the words carefully. Carefully. A 401k does not pay UBIT when it borrows to acquire or improve real estate. Pound those words into your head. A 401k does not pay UBIT when it acquires real estate with the leverage or it improves real estate with the leverage. Let me give you an example of what not to do, or at least you won't get the exemption. I have a free and clear rental in my 401k. I borrow on it, and then I go out and buy notes. Well, the debt was not used to acquire or improve real estate. It was secured by real estate, but it was used to acquire notes. You don't get the exemption. So that's a powerful exemption. If your 401k invests in a trade or business directly or indirectly through an investment in a PPM, LLC, whatever, it's going to pay UBIT. We can cut the tax rate. The way to do it is the 401k forms a 100% owned C corporation. The C corporation then acquires the interest in the business, whether it's direct, it buys a Dairy Queen, or indirect, it buys shares in a PPM that has a whole bunch of Dairy Queens or flips or development or whatever. Instead of paying UBIT, the C corporation pays corporate rates. Well, right now, corporate rates are 21%, and even under Biden, they're supposed to be only 28%. UBIT, on the other hand, is 37% once you make it past the first $12,500 of income. So usually it's a much higher rate. What happens when you distribute a dividend from a C corporation to John? There's another tax, the double tax. Not good. Makes me sad. Observe. See? Sad. What happens when the C corporation distributes to the IRA or the 401k? Nothing. C corporations pay tax once when they're owned by a 401k or an IRA. So what happens? If you have what we call these blockers, why? Because they block UBIT. So if you have a trade or business directly or indirectly owned by the 401k, consider a blocker, because instead of paying the 37% UBIT rate, you would end up paying the presently 21% corporate rate, or what will be probably the 28% Biden rate. Still with me, Rachel?
Oh, yeah.
Okay, cool. Making sure. I'm not used to quiet women. I don't
Only
live
for you,
with
John.
one. All right. Very briefly, I mentioned I would show you some leg. The last two slides were leg. And just like at the bar, you get to see the leg for nothing. You want to see more? You got to put coins in the machine and bring the dollar bills. As it happens, we're doing a workshop in Atlanta, February 27th and 28th, so Saturday and Sunday at the Atlanta Airport Marriott. It's a massive room with serious amounts of social distance. We are doing it live and streaming. Everybody will get a recording once they sign a waiver acknowledging that the recording is my property and you have a license to use it, but not to share it. Can you tell I'm a lawyer? About half of this will be Q&A. Half of this event will be Q&A, and we're going to be talking about the prohibited transaction rules in detail, UBIT in detail, planning techniques like the two we just shared in detail. And about half the event's going to be Q&A. So I'm happy for you to contact me, and there's contact information on the first and final slides. I'm happy to have a private consultation where you get actual legal advice at $500 an hour. Not a problem, makes me happy. Another way to do this, or I should say really a supplement, would be showing up in person or virtually on the 27th and 28th. And let me throw in one last reason to show up in person if you're comfortable. We don't want you doing anything you're not comfortable with. And obviously we were in the midst of a plague, so not everyone will be comfortable. The networking is phenomenal. The quality of people who show up to these events and what you learn by talking to them, preferably from 6 feet away with a mask, it's just through the roof. So there's a link there. And, you know, as they said in The Godfather, I would prefer you use this link instead of my link if you just choose to go to the event. Why? So that as they said in The Godfather, the neighbors can wet their beak. Very important. People must be able to wet their beak. And that covers the presentation. So if we have questions,
Yes.
snide comments, dirty jokes,
Yeah.
I'm going to go ahead and stop sharing then.
Okay, yeah.
And I'll bring it back up at the very end for the info. There's the spot with my info.
And you guys should see now at the bottom of the screen here, there is a nice button right about there that says register for John's workshop. So if there are any parts of this presentation where you're like, yeah, I got it, love it, want to learn more, that workshop is going to be the place to do it. If your eyes are swimming and you're going, what is he talking about? Then you want to go to this workshop. If you've had the solo 401k for a week, if you've had it for 10 years, there are things that you're going to learn. Like John said, the ability to learn with him and meet other people that are doing what you are doing is invaluable. Sometimes when you start talking to people about being able to buy real estate or Bitcoin or doing private placements in your retirement plan, they look at you like you are crazy. I know that there have been some of you that have tried to open bank accounts that have been politely asked to leave when you were trying to open your 401k trust bank account. You are not crazy and you are not alone. This is a really good place to tap into some community and to get some for real help. So definitely click on that link. We do have a couple of questions here. We only have a few minutes left here. So this is not a John's here, ask him all the questions. This is let's really drill down on some of the Secure Act stuff. And also, okay, there's a couple of questions here too, John, that seem like a little bit more general solo 401k. So I'll help with some of those. So Dave says, for example, can you list step-by-step guidance from opening the solo 401k to contributing to the solo 401k? Yes, we can. Absolutely. So go to your 401k dashboard. Dave, I know you have it. Click on support at the top of the screen. That'll take you to the knowledge base. We literally have hundreds of articles that walk you through the solo 401k setup process, how to initiate the rollovers. There's pictures and everything. It's very user-friendly. So
you guys are really into redundancy. And I mean that as a compliment. Like, we don't want to just be redundant and say it. Like, tell them what you're going to say, tell them, say it, and then tell them what you said. You guys like do redundancy.
Yeah.
And that's a compliment.
Yeah. There's guides. They've got pictures. If you prefer videos, we've got videos. But there's lots of support there for you. So Dave, make sure that you go and check that out. Okay, let me see here. A question for William, or from William. William says, John, do you know of anyone being fined for not designating their contribution by December 31st?
No, I haven't heard of it.
Awesome. All right, let's see what else we got. I think that there's some people that are just like, got stars in their eyes, so this is great. All right, Glenn says, I contributed in 2021 for an after-tax Roth 401k. I contributed in 2021. On which W-2 is the contribution reported, 2020 or 2021?
What did you intend? In other words, if you had something at the end of 2020 that said we intended to contribute for 2020 and you actually had the proper type of income, whether it's salary or flow-through compensation, depending on the type of entity you have, if you had the type of income in 2020 needed to do it, and you want to say that's 2020, go for it, as long as what? You don't lie. So if your designation was not in writing, get it in writing and say, as of 12/31/20, I intended to contribute, and sign it, well, let's see, February 2nd of 2021. So the key is be honest with it. I suspect with 2020, there's going to be leniency because of the ambiguity of the statute. Most of these new laws the IRS has been very generous in terms of technical corrections and allowing for the taxpayer to do things when it was ambiguous.
Yeah, I think they kind of have to be, especially, like we were saying earlier, it's kind of interesting timing with the Secure Act, which is, not an insignificant overhaul to especially 401k plans, really extending that deadline. Look, the IRS does not want a bunch of senior citizens on welfare. They don't. They don't want a bunch of old people on the dole. So they're trying to do what they can to encourage people to save for retirement. And that sometimes means letting part-time employees come in if they've worked 500 hours or more for 3 years in a row, letting people set up 401k plans, employers establish 401ks right up to the tax deadline. The IRS is doing what they can to encourage people to save for retirement. They did not know, or did they, that the pandemic was coming. So I think for them to release the Secure Act and then be hit with the pandemic and then have to release the CARES Act, there's just, I think it's a big mess, a flurry of activity over there. So
yeah.
So, all right, cool. That's great. This is a little bit more of a general question, John. You mentioned that 401ks are superior to other retirement options. Can you elaborate and provide examples? You did that a little bit of already, but if you have any more you'd like to share. I am new to contracting, and I'm trying to decide whether to put money in a SEP IRA or a solo 401k. Thanks.
Oh, solo, hands down. Solo, hands down. Prohibited transactions destroy SEPs and regular IRAs. That's the number one reason. I sleep better knowing if I make a mistake, not so likely in my case to be completely not humble about this, because it's what I do for a living, right? But the prohibited transaction rules, when we sit and go through them, there's a lot of gray. There's a lot of complexity. And if you slip up, it's nice to know that you're just going to pay a penalty. We don't want that, but it beats destruction. The UBIT exception I talked about on borrowing for real estate, the contribution limits, the flexibility that you can be the custodian, the trustee for your own 401k, with a caveat, know thyself. Some of you should not be the trustee or custodian. Some of you are geniuses at finding deals, and you couldn't fight your way out of a wet paper bag administratively, even if we gave you a flamethrower and a straight razor. So you do have to be honest with yourself about, would I be a good trustee? But you do have that capacity, the ability to borrow from the account. And again, not optimal. I don't like taking money from the tax-free environment and bringing it into the hostile taxable world. But it is nice to have a source of emergency funds just in case you ever need it. So those are the primary reasons I think the 401ks are superior. But by far, it's going to. That's, by the way, what I did. How did I grow my solo 401k? Until recently, I bought rentals 100% leveraged from private money people who are willing to do non-recourse. And by the way, everyone says you have to have non-recourse debt when you use a 401k. That's not exactly correct. Non-recourse is conservative, and it's the way most people go. A prohibited person, or I should say a disqualified person, is not allowed to guarantee it. If I can get a bona fide guarantee, and we're going to talk at the workshop, what's bona fide? A bona fide guarantee from a non-disqualified person, which usually means I paid them, then you can have a guarantee. Little known loophole. But bottom line is, I don't pay UBIT when I buy real estate. So in my 401k, I bought rentals 100% leveraged from 09 to 13, really cheap, 100% leveraged, kept my 401k money as a reserve for repairs and such, and we have sold all but 2 of them now. That and the prohibited transaction protection alone make 401ks superior.
I would agree with you on all counts there. Your video has cut out for me. If you want to refresh your screen, then there you go. Now you're back. Hello.
Okay.
I just want to piggyback on one thing that you said about the contribution. So Lisa, for you, for a SEP IRA, you're allowed to do the 25% employer profit sharing contribution. With a solo 401k, you can sort of legally double dip in doing the employee and employer. Now, the amounts are the same, 58 grand, that's that. But if you are maybe a new business owner, you're earlier on in your path, you can make less money and contribute more with a solo 401k because of that employee bump. So I think work with your tax professional, do a cost benefit analysis. But for some people, that little extra bump, in addition to everything that John said that makes 100% sense, can also then get you there to get more money in there.
Let me add something. This is important. What she was really saying was that the salary that you pay to get the employee match in the SEP has to be higher. You can pay a much lower salary in the 401k and make the same contribution through the after-tax Roth channel. And by the way, you guys were the first ones to come up with that, with the Mega Roth. Yours the first plan documents I ever saw that had that language.
That I tip my hat to that. I want to touch base on the workshop because I know we're getting some questions about the workshop, and it's going to be very exciting. So first is, I just saw we've had some questions rolling in, but okay. Well, first of all, Rami says, John, I haven't seen you take a sip of rum yet in an hour span. Are you okay? So I've seen you on webinars too. So he's okay, folks.
I was behaving today, and truthfully, I'm in the office and I had no alcohol in the office, and it's embarrassing to admit that.
So here's the truth that comes out, the sad truth. You're unprepared for today's webinar is what I'm hearing. So, okay, next question. So Tom says, I can't attend Atlanta. Will a recording become available later?
Yeah,
yes.
It'll probably take 3 to 4 weeks for the recording to become available because of the indexing and editing.
But not only that, Tom, if you go and you complete that form here, because what that's going to do is let John's people know that you are interested in registering. They'll make sure you get a link to register for the workshop. And actually, John's team has said it's okay to attend virtually. So Tom, if you can't make it, or anyone else, you can't make it to Atlanta, you can stream it. It'll be streamed live. You can attend right from your house. So if you are not traveling right now, that's okay. You can still attend that workshop. And we would highly recommend that you check it out. Click on that link so that you can access the team or access the link for that, the registration. And then the next question about the workshop here we have from Yun Hee. Oh, good, Tom. Great, thanks. Streaming is good. So is steaming. So good, Tom. Is there a fee to register?
That costs extra. You want to steam together, that's going to cost you.
They're going to clip that in YouTube, and then I'm going to be famous for a whole nother reason. So, okay, here we go. Next question from Yun Hee. Yun Hee says, is there a fee to register for the conference?
Oh, hell yeah.
Yeah.
Yep, $7.99, which is less than is that about an hour and a half? It's a little more than an hour and a half of my billable time. So I'm happy to do the same thing on the clock by the hour. I'm good.
And this is 2 full days, guys, just so you know. And John has an extensive program that's planned, including some of the topics he talked about before: IRAs, 401ks, prohibited transactions. He's talking about the redheaded stepchildren, Coverdales, HSAs. There's a lot of that's going to go into this. So attend virtually, attend live, or view the recordings at a later date. That is absolutely possible for everyone. Okay.
And by the way, for those who haven't heard of me, I've been around for 25 years. My last name is eminently Googleable since it's so strange. I'm out there, and I've I've managed somehow to not thoroughly ruin my reputation. Just Google.
Yeah. You're great. So, okay, Madhukar says, what is the last date to deposit 25% employer contribution into the 401k for the 2020 tax year?
The extended deadline of the return. So probably September 15th or October 15th, depending on which return you're filing.
Awesome. Oh, We'll try to do one more question here, guys. I know that there are several questions that some of you had that you were helping each other about payroll providers and things like that. Some of these questions where you're talking about doing after-tax contributions, rolling them to Roth IRAs, converting them to Roth IRAs, doing, how to calculate stretch distributions for the Secure Act for a Roth IRA for grandchildren. These are the types of questions that John has specifically carved out time for in this workshop. So if you have these questions, that's a good thing. That means your brain is working. We like to say that our clients have the wrinkliest brains because every time you make a new learning and you've got a new neural connection, you're getting a new wrinkle on your brain. So this is a great weekend to beef up those wrinkles, and you're already getting wrinkly brains now. And if you have continued questions, it means that you want to work with a professional who can really help you. So our team is here to help with things like, logistics and opening bank accounts and brokerage accounts and things like that. If you want a deeper dive, and you should, if you are starting to really use your 401k or your IRA LLC, then you definitely need to consider going to this workshop. John, you've carved out a lot of time just for Q&A so that people can cover things like this. Yeah. And yeah, Brian, to answer your question, yes, the recording of the event is $7.99 because it's as if you were able to attend live.
Either one. Yes, live, virtual attendance. The people who attend live or virtually will get the recording. So if you can't make it, I would sign up for virtual. And even if you don't watch the virtual, you'll still get the recording.
Awesome. So this will be our last question from Thomas. Oh, I'm sorry. What did you say, John? I spoke over you. I'm sorry.
Oh, no, that was it.
Okay. So our last question here comes from Thomas, and Thomas says, can solo 401k funds be used to pay the $7.99?
No, I wouldn't do that. And here's the reason. You're gaining a personal benefit of knowledge from this. And so as much as I would like you to come and pay, if that's the only way to come, you shouldn't use that money to do that. That's almost certainly a prohibited transaction.
Yeah, I would agree with you on that. Typically, those types of personal education expenses are not covered under the 401k plan. So, all right, guys. Well, this was awesome. We hope this will be our first of many trainings with John. You're a rock star, John. Please click on that link below so that you can learn more about the workshop. John's team will reach out to you. Make sure you have a link to register. And this recording will be available. We'll have it up on the Solo 401k network. It'll be in this week's newsletter, and it'll be up on the blog at solo401k.com. Thanks, everybody, for joining us. Thanks for being with us, John.